Welcome to Oraculum Accounting. In this chapter, we are discussing GST filing and other indirect taxes. This module introduces the principles, procedures, and compliance requirements associated with goods and services tax and other indirect taxes within modern financial systems. It explains how indirect taxes operate in practice, how GST is calculated and reported, and how businesses fulfill their legal obligations through proper record-keeping, filing, and payment processes. It also explains the interaction between GST and other indirect levies, the responsibilities of registered entities, and the accounting treatment of tax-related transactions, liability to pay GST, and entitlement to input tax credit. Under GST, the primary liability to pay tax rests on the supplier of goods or services. The supplier charges GST on taxable supplies and remits it to the government after adjusting eligible input tax credits. In certain situations, such as reverse charge mechanisms or imports of services, the recipient becomes responsible for paying GST. Registered recipients are entitled to input tax credit on GST paid on business purchases, allowing them to offset this against output tax liability and avoid cascading taxation. Turnover thresholds for GST registration. Registration is required when a business's annual taxable turnover exceeds a prescribed threshold. This ensures small businesses are not burdened while larger entities participate in the tax system. For example, in India, goods suppliers must register above INR 40 lakhs and service providers above INR 20 lakhs. Certain activities like interstate supply may require registration regardless of turnover. Process for GST registration. GST registration involves submitting an online application through the government portal with business details, uploading supporting documents, and verification by authorities. Once approved, a GST identification number is issued, allowing the business to collect GST, issue invoices, and claim input tax credits. Ongoing compliance includes return filing and record maintenance. Difference between tax, indirect tax, and GST. Tax is a compulsory financial charge imposed by the government. Indirect tax is collected by an intermediary and passed to the consumer. GST is a value-added indirect tax applied at each stage of the supply chain with credit for input taxes. Tax, broad government levy. Indirect tax, passed to consumer, two-structured value-added tax system. Example of GST treatment in a transaction with net and gross values. A manufacturer sells goods for a net value of 100. GST at 10% adds 10, making the gross value 110. When sold further at 150, GST of 15 is added, making 165. The wholesaler pays only the difference after input credit. Net value, excluding GST. Gross value, including GST. Output tax, GST on sales. Input tax credit, GST on purchases. Net tax payable, output minus input tax. Input tax and output tax under GST. Output tax is GST collected on sales. Input tax is GST paid on purchases. Businesses claim input tax credit to reduce liability. The net GST payable is the difference between output tax and eligible input tax credit. Monitoring of GST obligations for a business. Compliance is monitored internally by accounting functions, ensuring correct classification, invoicing, and timely filing. External monitoring is conducted by tax authorities through digital systems, data matching, and audits. Professional advisors may assist in maintaining compliance. Preparation and filing of GST returns. The process includes maintaining records of transactions, classifying them correctly, calculating output tax and input tax credit, and determining net payable tax. Returns are prepared and submitted electronically within deadlines. Tax due must be paid, and records retained. Record transactions systematically. Reconcile data before filing. Compute tax liability. Submit returns on time. Pay tax and retain acknowledgement. GST filing periods and compliance cycle. Returns are filed monthly, quarterly, or annually depending on rules. Larger businesses usually file monthly, while smaller ones may file quarterly. Each cycle includes recording, reconciliation, preparation, submission, and payment. Other indirect taxes. Apart from GST, Governments may levy customs duties, excise duties, stamp duties, and environmental levies. These taxes apply to specific goods or transactions and are borne by consumers. Example of chart of accounts with GST, VAT. A chart of accounts separates tax accounts from revenue and expenses. Sales revenue net of GST, purchases net of GST, output GST payable, input GST recoverable, GST payable to authority. Certain accounts like wages and income tax remain outside GST scope. Businesses not liable to register or charge GST. Businesses below the threshold or supplying exempt goods and services may not be required to register. Entities dealing only in out-of-scope transactions may also fall outside GST. Scenario: when one party in a transaction is not registered for GST. If the supplier is not registered, no GST is charged and no input credit is available. If the supplier is registered and the buyer is not, GST is charged and becomes a cost to the buyer. Non-profit organisations and other entities with no GST obligations. Non-profits and similar entities may not be required to register if they operate below thresholds or supply exempt services. Donations and grants are usually outside GST. Commercial activities may create GST liability. Conclusion to the module: GST filing and other indirect taxes. This module outlines GST concepts, compliance processes, and the role of indirect taxes in financial systems. It highlights registration, filing, tax calculation, and reporting requirements, reinforcing the importance of accurate compliance for transparency and consistency. This concludes the chapter. Thank you for watching. Subscribe for more informative content.